Let me talk about the information in an inverted yield curve that's relevant for where the economy is going. So the idea of inverted yield curves predicting economic growth is fairly popular today. But let me start off by telling you my journey to discovering this idea. So I was a first year master's student and I applied for a summer job, like an internship. I had two offers. One was in corporate development at a company called Torstar, and the other was kind of the same job in corporate development at the largest copper miner in the world at the time, called Falconbridge. And I chose to work at Falconbridge. When I walked in the first day, I was given a job for my summer that I was to develop a model to predict real GDP in the US. And I thought, well, okay, no big deal. In hindsight, thinking about it, it is kind of extraordinary. Because if you think about what's important for a copper miner, it's knowing in advance what will happen in the economy. So copper prices move with GDP. Indeed, it's sometimes referred to as Dr. Copper, as an indicator of the state of the economy. So this number is crucial in terms of planning. So whether you're doing exploration, whether you're opening a mine, closing a mine, this single number is crucial. And I'm put in charge as an intern with very limited work experience. Looking back on this, it seems extraordinary, but at the time, it was no big deal. So I set out trying to figure out how to approach this problem. At the time, there were two or three leading companies that specialized in economic forecasting. And they employed dozens of PhD statisticians and econometricians. They had giant models, extraordinary computing power at the time, and the best possible data. And they were expensive. It was like $50,000 to $100,000 for a forecast. And I knew in 10 weeks, there was no way I could compete with that. So I had to have a different approach. And my approach was to look at asset prices. And I'd read some papers by somebody at the University of Chicago, Eugene Fama, and he was looking at the relation between stock prices and GDP. And the idea is very intuitive, that the stock price is based upon not the past, but the future. So investors figure out what the expected cash flows are and then discount those to get a price. Well, expected cash flows surely depend upon GDP growth. There should be information in the asset prices that's relevant for future economic growth. So I went with that idea, but I knew his paper, and the paper suggested that stock prices were very unreliable. They delivered many false signals. So meaning predicting a recession didn't happen. So I thought about, well, what about using another asset, a bond? The same idea. So the bond price today is dependent upon the value of the future cash flows. But there were a lot of differences that were very convenient. So for example, for a stock, the dividend is unknown. For a bond, the coupon is known. For a stock, there's no expiration, there's no maturity. Whereas with a bond, you know what the maturity is. And then number three, to discount those cash flows to present value to get the stock price, the discount rate is variable and risky. Whereas with the bond, it's fairly risk-free. So I started to focus on bonds, and I found that looking at a long-term yield minus a short-term yield was highly predictive of GDP. It was a very exciting result. And this most people don't know, I was about to present to senior management, and I walked in the day of the presentation and was told that the entire corporate development unit had been laid off. So I'm out of work. With 4 weeks to go, really not that many opportunities. So I continued working on the paper. And when I went back my second year, my professors encouraged me to apply for a PhD. And that's exactly where I landed up at the University of Chicago. And my dissertation in 1986 documented this relation between the slope of the term structure, or the difference between that long rate and short rate, and future real GDP growth. My committee obviously was somewhat skeptical. I really only had 4 recessions, but they liked at least 3 things in my paper. So number one, the economic foundation of my paper was solid and not controversial. Number two, they liked that my model got the so-called double dip recessions of the early 1980s. And these very large, expensive services did not get the double dip. They just forecasted one recession. And number three, my committee liked the model because it was simple. Indeed, to get a forecast of real GDP, instead of paying $50,000 to $100,000, at the time, all you needed to do was to spend 25 cents on a Wall Street Journal, and you got my forecast. So usually what happens after you publish your dissertation, it was published in 1988, 1989, that 2 things happen. So number one is the good scenario, and that is that the effect gets weaker. And the other scenario is the bad scenario, and that is the effect completely goes away. It turns out that is not what happened in my situation. So in my situation, the model continued to work. So the first test was actually in 1987. And when the stock market crashed by 25%, there was widespread agreement amongst economists and forecasters that the US was headed into recession in 1988. However, the yield curve wasn't inverted. So I went with my model. And I remember being at a conference as the most junior person speaking. Everybody was doom and gloom. And I said, well, I thought the growth was going to be 4.1% in 1988. And I remember the laughter. It was kind of painful at the time. I was a bit embarrassed until the end of 1988, when growth came in at 4.2% and there was no recession. So this is an example of the model not giving a false signal. Okay, so we go through time, and my model accurately forecasts the 1990-91 recession, gets the 2001 recession, there's no false signals, and then it actually gets the global financial crisis recession, and that was a big one. So it had very little attention associated with the model until the global financial crisis. Then people noticed, oh, this model is 7 out of 7. And you can see right here that we've got in red the spread between the 10-year and the 3-month. And when you go below the horizontal black line, that means an inverted yield curve. You can see that the yield curve inverts before all of these recessions, and there's no false signals. So this is an analysis of kind of the lead time, and there's a couple of things that are very interesting in this analysis. So first, the lead time to recession is variable. So it's not fixed. And over the last 4 recessions, the lead time from an inversion to the beginning of a recession is 13 months. Today, we're at 12. So we're not quite at the average yet. And then the second interesting thing is the close relationship between the length of the inversion and the length of recessions. So it's very, very close. So indeed, over the last 4 recessions, we're within like 2 months, plus or minus 2 months. So it's very good at giving an advance warning and telling you how long the recession will actually be. So again, this was ignored for so many years. Indeed, I got some interesting emails from people involved with Treasury and Fed during the global financial crisis, where the Fed and Treasury completely ignored my indicator and kept short-term rates very high, even though they were being told, hey, this indicator is screaming recession and we need to do something about it. So today is different. And this is 2019 when the yield curve inverted. All of a sudden, this is in the news. Now, 2020 recession obviously is special because it was induced by COVID. We'll never know what the counterfactual actually is. So if there wasn't COVID, would there have been a recession in 2020? Well, maybe. Indeed, the Duke CFO survey, 75% of CFOs thought there'd be a recession in 2020 or the first quarter of 2021. So after the COVID, we're 8 out of 8. But today, we've got an inverted yield curve. So you can see we've been inverted, as I said, 12 months. And the size of the inversion is pretty severe compared to the size of the actual interest rates. And the question is, will we have a recession? So again, if you look at the size of the inversion relative to the average long-term rate, you can see that this inversion is historically unprecedented. Okay, so let me rewind to the beginning of 2023. So in looking at the data, I see an inverted yield curve. It's been inverted for a couple of months. And I'm thinking this is probably a false signal. So I did a LinkedIn post on January 4th and made my case that this could be a false signal. But there was one major caveat in the post. And that caveat I will talk about in a minute and has to do with what the Fed needed to do. So I saw, number one, excess labor demand, where you've got many more openings than unemployed. And then my logic here is that even if we go into slower growth, it doesn't mean a lot of people will be unemployed because of the excess openings. I also commented on nature layoffs, many of them in tech. And if you're laid off at Twitter, you're almost immediately employable at many other firms. I also talked about housing. And housing was in much better shape in 2023 than, let's say, during the global financial crisis. And what I mean by better shape is that owners have much more equity compared to their debt. And this graphic shows the very large gap. Number 4 point I made is a subtle point having to do with causality. So my original model in my dissertation, there was no causality. But I believe that given the indicator is so popular today, that there is causality. And let me give you an example of that. So during the global financial crisis, the CEO gets in front of the shareholders at the annual general meeting and says, look, I know the results are terrible, but we had no idea that we'd be in a deep recession like this. We were blindsided by this recession. And not just us, but our competitors are in the same boat. And people, yeah, that seemed reasonable. But Can you imagine in 2024, a CEO going before shareholders, assuming there's a recession, and in 2023, the CEO made a very large investment, took a lot of leverage, going before the shareholders and saying, oh, well, we had no idea a recession was coming in 2024. Well, that would be met by laughter. This is the most predictable recession, given people talking about the inverted yield curve. So that changes behavior. So it's less likely that you bet the firm on a large investment project. It's more likely you cut back on your hiring or maybe do a 10% layoff to make sure that if there is a recession in 2024, that your company is going to be strong enough to survive. So this is the so-called self-fulfilling prophecy, and it's a channel of causality. So with the inverted yield curve, people see that, they reduce their spending. That reduced spending actually decreases economic growth. And that's a good thing. That's risk management. It's way better to survive via risk management than to go out of business. So there were other possibilities in terms of causality here. And the second channel of causality has to do with the banking system, which I'll talk about in a minute. So number 5, this model, very simple. It's one variable. So again, think back to my summer job where these companies had hundreds of equations and numerous variables. The economy is very complex. And it's kind of naive to think that this single variable, the long-term rate minus the short-term rate, is going to do a perfect prediction every single time. It's a model. All models, by definition, are wrong. This model is done well. It's 8 out of 8, but it could be wrong. Okay, so the caveat in my post was that the Fed needed to end the tightening. And if the Fed continued to tighten, that would put the economy at risk. And that's exactly what the Fed did. The Fed continued to tighten, continued to hike rates, in my opinion, unnecessarily, and potentially setting up a situation where we have a recession that was possibly unnecessary. So I do want to kind of go through the mechanics of this. So let's talk about inflation a little bit. And I think everybody agrees, including the Fed now, that the Fed was very late in terms of raising rates. So for years, the Fed held rates near zero, and it made no sense to me whatsoever. During a period of robust economic growth, with record low unemployment, record high stock prices, how can you justify having a Fed funds rate of 25 basis points? That is distortionary. And then when inflation started to increase, the Fed said, well, it's transitory, but then realized it wasn't. And then the Fed had to raise. So the Fed misread the inflation data, and they continue to misread the inflation data. So let me kind of go into what a misread actually means. And it has to do with the treatment of the most important component of inflation, which is housing or shelter. And that is 35% of the CPI and 40% of the Fed's favorite indicator, the personal consumption expenditure deflator. So the key intuition here is that that housing costs and rental costs operate with a lag. So think about rents going up by 15%. Well, if you have to renew your lease next month, you're going to bear the price. So the 15% will be reflected in your next lease. But if you've got 11 months to go, it'll be a while. So the way that the housing cost is actually incorporated into the CPI is with something called owner's equivalent rent. And it is a smoothed version of the actual costs. And this creates a problem. So if we look at the market, we can see that housing sales are down. The year over year house prices are below 2% in terms of appreciation. And this graph is maybe the most important, and I want you to take a careful look at it. So in purple are actual rental costs, and the red is the CPI version, which is a smooth version. Think of it as a long moving average of the purple. And you can see that the red is about 1 year out of sync with the actual price data. Okay, so you can see that the CPI is reflecting 6.7% shelter inflation, but the actual shelter, real-time shelter, is closer to zero. And that 6.7% is very influential for the overall CPI, which is running at 3.2%. So this is just like an analysis of that 3.2% year-over-year inflation that we're experiencing right now. And notice that with inflation, there's two numbers that are really important: the most recent month, and then the month that you're dropping, like 12 months ago. And notice that for the next inflation release, we will drop a negative number from November of 2022. So what does that mean? That means even if inflation is zero month over month in the December release, inflation will go up. The same thing in January. So inflation will be up likely in December and January. And in my opinion, this might give the Fed reason to not do what they should be doing, and that is decreasing the Fed funds rate. So if we actually look and incorporate the true shelter inflation, not the lagged inflation, then inflation is more like 1.6%. So that number, I'll tell you how I get it. I assume that shelter is not 6.7, but 2%, which is actually very conservative. If I assume it's 1%, then the year-over-year inflation is 1.25%. Notice both these numbers are well below the Fed's 2% target. So again, the Fed has taken rates under the pretense that, well, inflation is not under control. They've taken rates well above where they should go. So again, inflation is not 3.2%. And policy needs to be developed, not based upon inflation that happened 12 months ago. That's history. We can't do anything about it. The policy needs to be developed based upon real-time inflation. And that real-time inflation, we're below the Fed target. And as such, the Fed needs a different strategy. Okay, I said I would return to banks, and now's the time to do that. And I refer to a second causality channel. And let me describe. So in the bank business model, banks gather deposits, pay a short-term rate, and then they lend the money out to corporations, individuals, or even the government by buying government bonds. And in doing that, they receive a longer-term rate. So when the yield curve inverts, that's not good for their profitability because they're paying out more in the short term and receiving less on the long term. So generally, inverted yield curves are not a great thing for banks. So the banks, they they need to deal with something else. And this has to do with the way that the yield curve inverts. So the yield curve can invert in many different ways. So both short-term and long-term rates could go down and the yield curve inverts. It just means that the long rate goes down by more than the short rate. But in this particular situation, the yield curve has inverted with both the long and the short rates increasing. And that is the worst possible scenario for the banks. So the inverted yield curve, as already mentioned, impacts profitability. But when those long rates go up, that impacts the balance sheet also. So that means that the value of their assets, think about holding government bonds. You buy the bond at a fixed coupon, rates go up. Well, that bond loses value. And we've already seen this kind of play out. So Silicon Valley Bank and other banks took a hit in March of 2023. And Silicon Valley is just an example of what happens when long rates go up and a bank takes so-called duration risk. So banks take two types of risk generally, credit risk and making their loans to corporations and individuals, but also duration, meaning that if you buy a long-term bond and rates go up, then the value of that bond goes down. So this is an example of the universe of banks. And SVB went down, but there's many banks that look similar to SVB. And this is worrisome because when SVB went down, rates, the long rate was 3.5%, and we're roughly 100 basis points higher today. And this just shows, and this data is only through the second quarter of 2023, but you can see the losses on the hold to maturity and available for sale, unrealized losses on investment securities, and they're very substantial. Indeed, about a third of bank equity has been wiped out. Okay, so this is the second causality channel, that when the yield curve inverts, and when it inverts, especially in a bad way, where both the long-term and short-term rates increase, this puts stress on profitability. It puts stress on the balance sheet. And that potentially can lead to a credit squeeze. Okay, so it's kind of interesting that the profitability channel we don't really see today because the rates on savings deposits have not increased substantially. So this means that if you're faced with a 10 basis point yield on a savings deposit and 500 plus basis point on a money market mutual fund, then you switch. You pull your money from the bank and go to a money market mutual fund. Okay, so what does that do? Well, that reduces the lending capacity of banks. The money market mutual funds, well, they just buy like treasuries and invest in repos and things like that. So what this does, this flight of capital from banking system to the mutual funds actually causes a credit squeeze. That credit squeeze is bad for economic growth. So again, I mentioned this profitability channel we really don't see. I actually challenge you, if you are a customer of a too big to fail bank, go and figure out what your savings deposit interest rate is. It's pretty shocking. So this is a couple of examples. And that 0.01, that's not 1%, that's 0.01%. So 1 basis point. Indeed, the most generous too big to fail bank that I can see is Citibank, offering 5 basis points. So again, 5 basis points compared to a money market mutual fund, that's over 500 basis points. So again, this to me is worrisome and indeed a red flag that we've got such a gap between market interest rates and what these banks can afford to actually do. Okay, so let me sum up. So at the beginning of 2023, actually believed that we could dodge a recession. However, given the Fed's actions of keeping rates too high for too long, I think that the probability of a recession is greatly increased. So no longer would I say that we can avoid completely a slowdown. So it is puzzling if you look at the data. And in the third quarter, we had 4.9% on an annualized basis real GDP growth. And that's robust growth. And people say, well, we've avoided a recession. But it's really important to understand where that growth came from. And that growth came from the consumer. So the consumer had built up savings during COVID. And there was also very generous government programs that added to those savings. And those savings have been run down. And indeed, they are likely to run down and run out by the end of 2023. The other component, key component of GDP is investment. That's already negative. So it's really the consumer that bailed out the economy in 2023. And I don't think it's possible for them to do it again in 2024. There's many different measures of savings that you can take a look at, and you notice that the savings are run down. One advanced indicator I like to look at is delinquencies, let's say on credit cards or auto loans. Like if you've got savings, you don't want to pay the interest on a credit card, you'd rather just uh, pay things off. But no, delinquencies have been increasing. And again, this is something that is a leading indicator, and it suggests that there will be slower growth in 2024. Consumers hit with many other things. So for example, the resumption of student loan payments that began in October of 23, that will take a hit. And also, as I mentioned, the credit squeeze. So that operates with a lag. It will take effect in 2024. So there are other things going on. For example, I mentioned that consumer real estate was in relatively good shape, but that's definitely not the case for commercial real estate. With an office vacancy rate of 35% in San Francisco, near 20% in Chicago, this market's cratering. And many of those, the real estate have loans with banks, and banks will have to deal with that in 2024. So it's not a great situation. So let me end off with some positives. So I still see this large gap, though it's decreasing, between the job openings and the unemployed. So that will serve to lessen the blow. And also, I think it's very important to realize that people have figured out this inverted yield curve, and many companies have taken actions that are in the motive of risk management, that they realize that there's a high probability of some sort of recession in 2024, and they've taken actions so they don't need to do mass layoffs. So I think when you put that together, and I'm hopeful that we will not see any more increases in rates, and ideally, we start to decrease the short-term interest rate, that you put that together, then we can lessen the blow. And what I mean by that is that we will have, in my opinion, a slowdown in 2024, but ideally, it is a soft landing. And a soft landing can be just slower growth, or it might be a mild recession. For example, the recession we had in 2001. Both of those would be ideal. In the end, even though I developed this model, the inverted yield curve predicting recessions, I hope the model's wrong. Nobody wants a recession. Recession is painful. It's not just a number. Like we summarize it with like negative real GDP growth, but it goes well beyond that. It's very costly, very painful to be laid off, very painful for families going through that stress. Nobody wants a recession. Indeed, I certainly hope that the Fed takes some actions to reduce both the probability of recession and, if there is a slowdown, the depth of the slowdown. They can do it. There's still time, but we need action.